Ever wondered what a $1,000 investment in Riot back in 2019 would be worth now, in 2024? Today that investment would be valued at nearly $4,000, representing a significant increase of 290% and an annual growth rate of a whopping 41%. Quite the impressive feat, wouldn't you say? But what's Riot, you ask? Well, it's none other than a leading player in the blockchain and cryptocurrency industry in the United States. From mining Bitcoin to data center hosting and engineering, Riot has its fingers in many pies. This diversity has proven to be a strength, helping the company navigate the volatile crypto market and deliver considerable returns for its investors. Intrigued? Let's delve into the financial analysis of Riot to understand this growth. We'll discuss everything from revenue and profit margins to assets, liquidity, cash flow, and the all-important DuPont analysis. So buckle up, folks. It's going to be an exciting ride. Riot's revenue in 2023 stood at $280 million, with an impressive annual compound growth rate of 209% since 2019. This growth trajectory has been fascinating to follow, with each year presenting a new chapter in the company's evolution. Let's take a closer look, shall we? Between 2019 and 2020, Riot's revenue grew by a substantial 71%. This was just the beginning. From 2020 to 2021, the company's revenue skyrocketed by an eye-popping 1,650%. The catalyst for this explosive growth? The boom in the cryptocurrency market, especially Bitcoin. From 2021 to 2022, the growth cooled but remained strong at 24%. And from 2022 to 2023, it increased by a modest 8%. While the growth has tapered off, it's important to remember that the most robust growth phase was between 2020 and 2021, driven by the surge in Bitcoin's popularity and value. Now let's delve into the structure of Riot's revenue. The lion's share of the company's revenue, about 68%, comes from Bitcoin mining. This is not surprising given the company's strategic focus on capitalizing on the Bitcoin wave. The remaining revenue is split between data center hosting, which contributes 10%, and engineering, which accounts for 23%. This revenue structure highlights Riot's business model, revolving around the mining of cryptocurrency, providing hosting services for data centers and offering engineering services. It's a diversified approach, allowing the company to tap into multiple revenue streams within the burgeoning blockchain and cryptocurrency sector. In conclusion, Riot's impressive revenue growth over the past few years can be largely attributed to the rise of Bitcoin and the company's strategic focus on this area. The company has leveraged the cryptocurrency boom to its advantage, resulting in a significant increase in revenue and a strong market position within the blockchain and cryptocurrency industry. The growth in revenue was fueled largely by the rise of Bitcoin and the company's strategic focus on this area. While revenues soared, Riot's gross profit margin in 2023 was 9%, with a 5-year average of 32%, indicating a downward trend. Let's take a closer look at this. Starting from 2019, Riot's gross profit margin was 14%, showing a reasonable start. But the real highlight came in 2021, when the gross profit margin peaked at an impressive 61%. This was a time of explosive growth for the cryptocurrency sector, particularly Bitcoin, which Riot heavily relies on. However, as we moved past the peak, the gross profit margin began to decline. In 2023, it dropped to 9%. This tells us that while revenues were increasing, the cost of goods sold was rising at a faster rate. It's a clear indication of increased operational costs, perhaps due to Riot's aggressive expansion and investment in infrastructure for Bitcoin mining. Now let's shift our focus to the net profit margin. The story here is quite different. Over the last 5 years, Riot's net profit margin has consistently been in the negative territory. Yes, you heard it right. Even in 2021, when the gross profit margin was at its peak, the net profit margin was -7%, and in 2023, it stood at -18%. So, what does this negative net profit margin tell us? It's not necessarily a sign of poor performance. In fact, it's quite common for rapidly growing companies like Riot to have negative profit margins. Why? Because these companies are usually more focused on growth and expansion, and less concerned about generating profits in the short term. They're willing to reinvest their revenues back into the business, often at the cost of their profit margins. And in the case of Riot, this strategy seems to have paid off. Despite the downward trend in profit margins, Riot's revenues have seen a phenomenal growth, and that's what really matters in the end. Negative profit margins indicate that Riot has been focusing on growth and expansion, which seems to have paid off in terms of revenue. Riot's total assets in 2023 were valued at $2.1 billion, a significant increase from $1.3 billion in 2022. This growth showcases the company's ability to expand its resource base over time, which is crucial for ongoing operations and future development. Now let's delve deeper into Riot's net assets. In 2023, the net assets stood at an impressive $1.9 billion, compared to the previous year's $1.2 billion. This rise in net assets is an encouraging indicator, suggesting that Riot is effectively managing its liabilities while increasing its asset base. A key ratio that aids in understanding a company's financial stability is the equity to total assets ratio. In 2023, Riot had a ratio of 90%, slightly lower than the 92% of 2022. Despite this slight decrease, the ratio remains high, indicating that a substantial portion of Riot's assets is funded by equity rather than debt. This gives the company a solid footing and reduces financial risks. Let's now turn our attention to the current ratio, a liquidity indicator that measures a company's ability to pay short-term obligations. In 2023, Riot's current ratio was 8.33, significantly higher than the 3.33 of 2022. This substantial increase illustrates that Riot has improved its ability to cover its short-term liabilities with its short-term assets. Another important measure of a company's liquidity is receivable days, which tells us how quickly a company collects cash from its credit sales. Riot's receivable days in 2023 was 26, a slight improvement from 28 in 2022, indicating that Riot has become more efficient in collecting its receivables. These figures indicate that Riot has been successful in accumulating assets and maintaining a healthy liquidity position. This financial stability is a promising sign for investors, suggesting that Riot is in a strong position to weather financial storms and seize new business opportunities. In 2023, Riot reported a positive operating cash flow of $30 million for the first time in 5 years. This is a significant milestone, reflecting a progressive stride in the company's financial performance. However, it's important to note that Riot's free cash flow in the same year was a negative $0.39 billion. What's the reason behind this? The answer lies in the company's aggressive investment strategy. Riot has been heavily investing in Bitcoin mining equipment, a crucial driver of its revenue. While this has led to a negative free cash flow, it's a calculated move aimed at long-term growth and dominance in the blockchain and cryptocurrency sector. Now, let's perform a DuPont analysis for the year 2023. The DuPont analysis breaks down return on equity, or ROE, into 3 components: net profit margin, asset turnover, and asset to equity. In 2023, Riot's ROE was negative 3%. The net profit margin, the measure of how much of each dollar of sales a company keeps in earnings, was negative 18%. This is an area Riot will need to work on to improve its overall profitability. Next, we have asset turnover, which measures a company's efficiency at using its assets to generate revenue. Riot's asset turnover was 0.13, indicating a need for improvement in this area as well. Lastly, the asset to equity ratio was 1.11. This ratio indicates the proportion of the company's assets financed by stockholders' equity. A higher ratio suggests more effective asset management, and in this case, Riot seems to be doing well. While the company's cash flow and profitability metrics may raise eyebrows, the DuPont analysis shows that Riot's asset management has been effective. Despite the challenges, Riot's strategic investments and effective asset management suggest a promising future. Stay tuned to see how this story unfolds. So, that's the financial story of Riot from 2019 to 2024. To recap, Riot demonstrated a remarkable expansion in revenue and assets. $1,000 invested in 2019 would have grown to almost $4,000 by April 2024, an impressive annual growth of 41%. The company's revenue growth has been primarily driven by Bitcoin mining, contributing 68% of its revenue. However, it's important to note the company's challenges in profitability and cash flow. Despite its revenue growth, Riot's profitability has been a concern, with negative net profit margins persistently recorded over the last 5 years. The company's cash flow scenario also portrays a similar trend with negative free cash flow. These are crucial aspects to consider in your investment decisions. As always, comprehensive research and understanding are key to successful investing. Please subscribe to our channel for more insightful analyses and leave a comment about which company you'd like us to analyze next.